OD Jacob here. Today we're looking at GrafTech International, doing a one-off video on them in the electrical equipment industry. They research, develop, and manufacture graphite and carbon-based solutions. Founded in 1886. Okay, so they've been around a while. 428 million market cap on 1.2 billion enterprise value. A lot of net debt here. Huge concern with this massive decrease in revenue, where in 2018 they had 1.9 billion in revenue and they now produce 621 million in revenue. Their income statement shows repurchases of shares, non-operating income expense fairly large, but even prior operating profit in the rolling 12 in 2023 was still negative. And that's just mainly because their revenue was substantially lower than before. Balance sheet shows a good amount of cash on hand, 177, but 926 million long-term debt. So long-term debt is down quite a bit from its peak in 2018 when I presume they purchased a company. Made some devastations over here. Interesting. Issued a lot of debt, but have been repurchasing it. Free cash flow is more positive than earnings. I like that. So they still produce free cash flow, just nowhere near what they were producing before. Looks like this. I don't know if this 2018 to 2022 is just a fluke or what, but prior they were making 50 mil maybe in free cash flow, and then after this devastation, um, they were making over 500 million free cash flow. So I don't know. I want to presume that just based on numbers, 2018 to 2022 is a fluke. If you know this business better than I do, then you'll obviously have an advantage there. But for me, just looking at the numbers, I don't know if I can rely on these margins of 40, 30% and such. So this is going to hinder my assumptions here, but I'll just make some assumptions here, I guess. Let's say they don't grow at all, because even in 2017, 551 million revenue to 621. So let's say they don't grow at all, 10p, or I guess I'll put an even lower one because their enterprise value is so much higher. Maybe let's do 6. So again, I've said this on videos before. Sometimes or a 0% growth business, given a 10% discount rate, would incur roughly 10 price earnings and free cash flow. So if you think that a company has no growth potential, then they should have roughly a 10p price to free cash flow. Here I'm saying that that's based on market cap. I'm bracing it more. I'm balancing the difference between enterprise value and market cap, where enterprise value is almost triple what market cap is. So I'm bumping down that P and price to free cash flow a bit. And then for margins, I mean, I don't know if I can trust these. If you understand this business and you think that they're going to get back to these margins, then absolutely, I think that there could easily be a buy here. But me personally, I'll probably go 5, or let's do 4, 8, maybe 1% share change. I don't know. I mean, it just gets tough here. This would be something where you'd really have to do digging on the company to see if they can get back to these margins. And I don't think there's really anything that I could research on my end that would make something make more sense than what you could do on your end. I'd really just have to look at 10Ks, 10Qs. How did the business change between 2017 and 2023? Why was there such big increases? Why was there huge margins over here, and we're getting back down to pre-devastation levels? Is this sustainable? Is it not? That's just going to be on your behalf to understand that. And for me right now, if they get back to those margins of 40%, yeah, it looks like a screaming deal. But is that reality? I just don't know if that's the case, given that they've really historically, the last 5 years since that devastation, just gone lower and lower in both earnings and revenue and margins and such. So, yeah, I would say that they're probably not going to be, or to me, it just doesn't seem like the most likely outcome for them to go back to those types of margins. But again, I'm just looking at the numbers. If you look at the business and better understand it and have a better inkling that they do go back to those margins, big props, and this will probably be a fantastic buy for you. But for me, I just don't know enough. And again, I could do more research to see if I do get it better, but based on my initial price, I'm saying that it needs to fall quite a bit. And even looking through 10Ks, quarterly reports, and stuff, you don't always get the answers you're looking for to make the most predictive assumptions. And so if I just can't be relied upon these assumptions, then it's really just an ixnay on the dictionary for me, because I need to be able to appropriately calculate all of these things. If there's one or two that I can't do, then I just don't trust the figures and I can't follow through with it. But if I have a story that I can back up these figures with, then obviously it's going to make a lot more sense. But for me right now, no. And then let me bring up one more point. It is in the NASDAQ, and the NASDAQ has a requirement that you need to be above $1 for the actual stock price. And so keep that in mind if you are looking to invest in this. If they go under $1, there's a certain period of time that they need to get back above that, or else they're uncompliant. So hopefully you enjoy the video. I know it wasn't probably what you were looking for, but hope you have a great rest of your day. Thank you.